You finally did it. After years of grinding, maxing out retirement accounts, and watching your portfolio crawl upward like a wounded animal, you crossed the six-figure threshold. $100,000 invested. You screenshot the number. You tell your spouse. You feel like you've cracked some kind of code that most people never figure out. And then something strange happens. A year passes. Your balance is at $112,000. Another year, $119,000. 3 years in, you're sitting at $131,000, and you start doing math that doesn't feel right. At this pace, hitting $1 million isn't going to take another decade.
It's going to take the rest of your natural life.
You were told that the first 100,000 is the hardest. You were told that after you hit that magic number, compound interest takes over and the money starts to snowball. You were told that getting to $1 million is just a matter of staying the course. But nobody told you that between $100,000 and $1 million, there's a psychological and mathematical wasteland. And I spend way too much time studying why the investing advice that works on paper falls apart in real human lives. If you're someone who has built up a decent portfolio, but feels like you've been running in place, or if you're working toward that first 100,000, wondering what actually comes next, make sure to hit that subscribe button and give this video a thumbs up. Because today, we're going to expose the lie embedded in the first 100,000 is the hardest mantra. We're going to look at the math that nobody shows you, the psychology that derails 90% of investors in this exact wealth bracket, and the specific traps that turn a six-figure portfolio into a permanent six-figure portfolio. Here's the thing about that famous quote. It's technically true. Getting from $0 to $100,000 requires the most personal sacrifice. You're doing all the heavy lifting. Your contributions dwarf your returns. If you invest $500 a month at 8%, after year one you've got about $6,200, and only about $250 of that came from investment gains. The rest was just you, manually shoveling money into the account. But here's what the quote doesn't tell you. The reason the first 100,000 is the hardest isn't because it's the steepest climb. It's because it's the only climb where the math is simple enough to understand. After $100,000, you enter a psychological twilight zone where the numbers become large enough to feel meaningful, the progress becomes slow enough to feel invisible. Let's run the actual math, because this is where the lie reveals itself. Say you have $100,000 invested, and you're adding $500 per month, at an average 8% annual return, which is roughly what the S&P 500 has delivered historically after inflation. Here's what happens. After 1 year, you have roughly $114,000. After 2 years, about $129,000. After 5 years, you're at approximately $183,000. Notice something? You added $30,000 of your own money over 5 years. Your portfolio grew by $83,000. More than half that growth came from compound returns. The math is working. But it doesn't feel like it's working because the absolute numbers are still moving in increments that your brain perceives as slow. When you had $10,000 and it grew by 8%, you gained $800. That felt like nothing. When you have $100,000 and it grows by 8%, you gain $8,000. That feels like something. But here's the trap. When you have $100,000 and the market drops by 8%, you lose $8,000. And $8,000 of loss feels catastrophic in a way that $800 of loss never did. This is where the psychology starts to poison the math. Behavioral economists call it loss aversion. Losses feel roughly twice as painful as equivalent gains feel pleasurable. So when your portfolio was small, a bad year was annoying. Now that your portfolio has weight, a bad year feels like someone broke into your house and stole months of your labor. And here's what loss aversion does to investor behavior in the $100,000 to $1 million range. It makes you flinch at exactly the wrong moments. A 2023 study from Dalbar, which tracks actual investor returns versus market returns, found that the average equity fund investor underperformed the S&P 500 by nearly 4% annually over the past 30 years. 4% per year, compounded over 3 decades. That's not a rounding error. That's the difference between retiring with $800,000 and retiring with $2.1 million. Where does that 4% go? It evaporates through bad timing. Investors panic sell during downturns and panic buy during euphoria, and this behavior intensifies dramatically once portfolios become large enough to trigger real emotional responses. At $10,000, you might intellectually know you should stay invested during a crash. At $200,000, that crash means you just watched $40,000 disappear, and every instinct in your body is screaming to stop the bleeding. The first 100,000 trains you to be a saver. The journey from 100,000 to 1 million requires you to become something completely different. It requires you to become someone who can watch 6 figures of net worth evaporate in a bad quarter and do absolutely nothing. Most people can't do that. Most people weren't built to do that, and nobody warns you that this is the actual skill you need to develop. But it gets worse, because there's another trap waiting in this wealth band that has nothing to do with market volatility. It's called premature lifestyle inflation, and it's the silent killer of portfolio momentum. When you had nothing invested, you lived like you had nothing. You were hungry. You were scrappy. Every dollar felt precious because you could see how slowly the pile was growing. But something shifts psychologically when you cross 100,000. You start to feel like you've made it somewhere. You start to feel like you deserve rewards. You start to think that because you've proven you can save, you've earned the right to loosen up a little. So maybe you upgrade the car. Not dramatically, just from the 12-year-old Honda to a 3-year-old Lexus. Maybe you start dining out twice a week instead of twice a month. Maybe you book the slightly nicer vacation rental because you've been working hard and you're not broke anymore. Each of these decisions feels small and justified in isolation. But here's the math that destroys portfolios. If your $100,000 portfolio is growing at 8%, it's adding about $8,000 per year before contributions. If your lifestyle inflation increases your spending by $400 a month, you've just consumed all of your investment gains and half of your contributions. Your portfolio flatlines. The snowball stops rolling. This is why people stay stuck at 6 figures for decades. They achieved the number, they celebrated the number, and they started living like the number was the destination instead of a waypoint. Let me show you 2 hypothetical investors because the divergence here is staggering. Investor A hits $100,000 at age 35. She continues living on the same budget, contributing $750 per month and never touching her investments. At 8% annual returns, she hits $1 million around age 52. 17 years. Investor B also hits $100,000 at 35. He decides he earned a lifestyle upgrade. His contributions dropped to $300 per month because his expenses rose. Same 8% return. At age 52, investor B has around $390,000. He's not even halfway to $1 million. At his trajectory, he won't hit 7 figures until his mid-60s, if ever. Same starting point, same returns. The only difference was the decision to reward themselves too early. Investor A built a $1 million portfolio. Investor B built a comfortable upper-middle-class existence that felt good in the moment and cost him roughly $600,000 in lifetime wealth. Now let's talk about the system-level trap, because this isn't just about individual psychology. There are entire industries designed to extract money from people in this exact wealth bracket. When you had $20,000 invested, nobody cared about you. Financial advisors didn't return your calls. Banks offered you their basic products. You were invisible to the wealth extraction apparatus because you weren't worth extracting from. But cross 100,000 and suddenly you're a target. You start getting calls from advisors offering to optimize your portfolio. You start seeing ads for private banking services. You get invited to seminars about tax strategies and estate planning. Here's what most people don't realize. The financial services industry has determined that accounts between $100,000 and $500,000 are the most profitable demographic to target. You have enough money to pay meaningful fees, but not enough to negotiate those fees down. You're financially unsophisticated enough to trust advice that benefits the advisor more than you. And you're psychologically vulnerable because you're just starting to feel wealthy and you don't want to screw it up. A 1% annual advisory fee sounds trivial until you do the math. On a $200,000 portfolio, that's $2,000 per year. Over 20 years, assuming the portfolio grows, you'll pay somewhere between $80,000 and $120,000 in fees depending on performance. For what? For someone to put you in index funds you could have bought yourself while skimming a percentage every single year. The investor who manages their own simple 3-fund portfolio and avoids the fee trap ends up with roughly 15 to 20% more money over a 30-year investing career. That's the difference between retiring with $1 million and retiring with $850,000. That's years of financial freedom that got quietly transferred to an advisor who added no value. There's also the complexity trap. When you're small, simplicity is forced upon you. You buy 1 or 2 index funds because that's all you can afford to diversify properly. But as your portfolio grows, you start thinking you need sophistication. You start believing that a 6-figure portfolio requires 6-figure strategies. So you add individual stocks because you should be picking some winners at this point. You add sector funds because you read that technology or healthcare is going to outperform. You add alternative investments because sophisticated investors diversify beyond stocks and bonds. You add complexity because complexity feels like progress. But the research is devastatingly clear. Each layer of complexity you add introduces new opportunities for mistakes. Every stock you pick is a chance to underperform the index. Every sector bet is a chance to time the market wrong. Every alternative investment comes with fees, illiquidity, and opacity that systematically transfer wealth from you to the product creators. The investors who reach 1 million fastest are almost always the boring ones. They buy total market index funds. They keep adding money. They don't watch the market daily. They don't react to headlines. They treat investing like a monthly bill, not a hobby. And they let the math do what the math does. Let me address the psychology of patience directly because this is where most investors in the 6-figure range break. There's a phenomenon called the expectation gap. When you're building your first 100,000, your expectations are low. You're just trying not to be broke. You're grateful for any progress. But once you have real money, your expectations shift. You start expecting your portfolio to perform. You start watching it more closely. You start comparing your returns to benchmarks and to other investors. And inevitably, there will be stretches where your portfolio disappoints you. The average investor holds a stock or fund for about 2.3 years before selling. Not because they needed the money, because they got impatient. Because something else looked shinier. Because they couldn't tolerate watching their boring investment do boring things while they read about someone else making a killing in whatever the hot asset of the moment was. This churn destroys wealth in 2 ways. First, you crystallize losses prematurely and miss recoveries. Second, you incur taxes and transaction costs with every change. The investor who changes strategy every 2 years pays an effective tax on impatience that compounds into the hundreds of thousands over a lifetime. The data on this is unambiguous. Vanguard studied their investors and found that those with advisors who prevented them from making emotional changes outperformed those without advisors by about 3% annually. Not because the advisors picked better investments. The advisors stopped the investors from sabotaging themselves. The value wasn't in the advice. The value was in the behavioral guardrails. If you're between 100,000 and 1 million, and you don't have an advisor, you have to become your own behavioral guardrail. You have to build systems that prevent you from reacting to your portfolio emotionally. Auto contributions that happen before you see the money. Quarterly check-ins instead of daily monitoring. Written investment policy statements that you have to violate deliberately if you want to change course. The goal isn't to be smart about investing. The goal is to be too structured to make stupid decisions when your brain is screaming at you to do something. Now, I want to address the timeline problem, because this is the final psychological trap. When you were building toward 100,000, you could see the finish line. A few more years of saving and you'd cross it. The milestone was achievable in a time frame your brain could process. But $1 million is different. Even doing everything right, most people are looking at 15 to 20 years from 6 figures to 7 figures. That's not a sprint. It's not even a marathon. It's a lifestyle that you have to maintain for 2 decades. Human beings are terrible at delayed gratification on that time. Scale. We discount future rewards aggressively. $1 million in 20 years feels abstract, almost fake. But a vacation next month feels real and immediate. So we take the vacation. We make the choice that feels good now because the future is too far away to compete. This is why the investors who successfully reach 1 million almost always have systems that remove the future from the equation entirely. They don't think about the million. They think about this month's contribution. They don't track their net worth daily. They check it once a year, maybe twice. They've designed their lives so that the right behavior happens automatically and the wrong behavior requires deliberate, difficult action. If you want to reach 7 figures, you have to stop wanting to reach 7 figures. That sounds paradoxical, but it's the only psychological configuration that works. You have to fall in love with the process and become indifferent to the outcome, because the outcome is 20 years away, and you can't white-knuckle motivation for 20 years. But you can build habits that run on autopilot while you live your life. Let me give you the concrete playbook for escaping the $100,000 to $1 million trap. First, raise your contribution rate every time your income increases. Not your lifestyle, your contribution rate. If you get a 5% raise, your retirement contribution should go up by at least 3%. This is how you avoid the lifestyle inflation trap automatically. Second, stop looking at your portfolio. Seriously. Check it quarterly at most. Every time you look, you're inviting your emotional brain to override your rational brain. The data shows that investors who check their portfolios daily underperform investors who check annually. Looking is not free, it costs you money and bad decisions. Third, automate everything. Contributions should leave your paycheck before you see the money. Rebalancing should happen on a schedule, not when you feel like it. The more decisions you remove from your investing process, the fewer opportunities you have to screw it up. Fourth, write down your strategy and tape it to your wall. Not for inspiration, for constraint. When the market crashes and you want to sell, you have to look at the piece of paper that says, "I will not sell during downturns," and deliberately violate your own commitment. That friction saves people millions. Fifth, find your baseline lifestyle and refuse to budge until you're at least halfway to your goal. If you can live on $60,000 a year when you have $100,000 invested, live on $60,000 when you have $300,000 invested. The gap between your income and your lifestyle is the only thing that builds wealth. Protect that gap like your future depends on it. Because it does. The lie we've been told is that reaching 100,000 proves you can reach 1 million. But reaching 100,000 only proves you can save. Reaching 1 million proves you can wait. It proves you can tolerate boredom. It proves you can watch your money fluctuate by amounts that would have seemed life-changing a few years ago and do nothing. It proves you can resist the consumption culture that surrounds you and the financial industry that wants to skim from you and your own brain, that constantly invents reasons why you deserve to enjoy your money now. The journey from 0 to 100,000 is a test of discipline. The journey from 100,000 to 1 million is a test of character. Most people pass the first test and fail the second. They build a respectable nest egg and then slowly, imperceptibly, leak it away through lifestyle creep, fee extraction, emotional trading, and impatience. They end up with enough to be comfortable but never enough to be free. You don't have to be most people. You just have to understand that the game changed when you hit 6 figures. The rules that got you here won't get you there. The psychology that served you as a saver will sabotage you as a wealth builder. And the financial industry that ignored you when you were broke is now circling, waiting to skim from your progress. The million isn't a destination. It's a byproduct of refusing to lose, refusing to panic, refusing to inflate, refusing to complicate, refusing to extract. Every dollar you don't spend is a dollar that compounds. Every year you stay invested through volatility is a year your money works instead of fleeing. Every fee you avoid is performance you keep. Every temptation you resist is wealth you preserve. The first 100,000 took discipline. The next 900,000 takes disappearing. Becoming invisible to the forces that want to separate you from your money. Becoming boring enough that nobody, including yourself, finds reasons to interfere with the math. Because the math works. It always works. But only if you let it. If this video made you see the journey from 6 to 7 figures differently, share it with someone stuck in that range wondering why the snowball isn't rolling.